The concept of support and resistance. Support and resistance are an integral part of technical analysis. These are specific areas, from where the price action is likely to pause and change its direction. In simple words, a support area has the potential to stop the falling prices, and traders expect the price of an instrument to recover from a support level. Similarly, a resistance area has the potential to stop the rising prices, and traders expect the price of an instrument to move lower from a resistance level. However, the support and resistance levels are not the absolute barriers, and they are often breached. In the concept of support and resistance, when the price breaks through a particular area, which was either identified as support or resistance, it becomes the opposite of what it was before. For example, if the price was falling, and it breached below a support line, then that support line will act as a resistance line in the future. Conversely, if the price was rising, and it breached above a resistance line, then that resistance line will act as a support area for the future price movement. It's worth knowing that a support or resistance area that remains intact for a longer time is considered a stronger area compared to the one that is newly established. At this point, you may be thinking, why do the prices stop and change the direction from these levels? It happens because these areas represent the demand and supply zones. It's a common phenomenon. The price will rise whenever there is high demand. Likewise, the price will drop whenever there is less demand. In other words, you can also say, support and resistance represent the bullish and the bearish forces in the market. Bulls attempt to take the price higher, bears then intervene and try to take the price lower. This tug of war causes the price to move in both directions and consolidate at several points, and that eventually leads to the formation of the support and resistance areas. How to identify support and resistance levels? One of the simplest ways to identify the support and resistance areas is by using the trend lines. The first thing is to visually spot the areas that are held intact, and then connect those areas using a trend line. The general rule of thumb is to connect at least two price points. You can establish a support or resistance area in uptrending, downtrending, or even in a sideways market. A support or resistance area in an uptrending market will have an angled trend line, while in the sideways market, it will be a horizontal line. You can also draw two parallel lines to indicate both the support and resistance areas at the same time. You can also find support and resistance areas by using a technical indicator. The most commonly used technical indicators for getting the support and resistance levels are the pivot points and Bollinger Bands. These indicators automatically calculate the levels using the predefined parameters. These levels also change with the price movement and are called the dynamic support and resistance levels. The support and resistance areas that are established using the trend line S remain static and do not change with the price movement. How to trade using support and resistance levels? There are different ways to trade using support and resistance levels. One of the simplest way is to buy at support and sell at a resistance. Another way is to trade the breakouts. A breakout takes places when an established support or resistance level is breached. The preferred way of trading a breakout is by placing the trade in the direction of the breakout. Let's understand these concepts further from this Euro/JPY chart, on which a support area is established using a trend line. The pair had dropped to these two levels earlier and managed to recover. After establishing the support line, the price once again moved lower and came close to support line. However, with the presence of a support area, the pair was quick to recover and moved even higher than the previous high. Let's take another example from this AUD/USD chart. A resistance area is established using a trend line. The pair had twice dropped from this level, and it is now acting as a stiff resistance area. Soon after the second decline, the pair recovered, and once again moved towards the resistance line. However, this time the price remained below the resistance line, and the pair resumed the downtrend, dropping nearly 200 pips. This Euro-CAD chart is an excellent example to understand the breakout. The pair had earlier attempted to move above these two levels and failed. A resistance area is then established using a trend line. Following the second decline, the pair moved further lower. However, after a few sessions, it once again moved higher, and finally closed above the resistance line. The closing above the resistance line confirms the breakout, and following the breakout, the pair gained over 300 pips. This brings us to the end of this lesson. In the next lesson, we will go over the Fibonacci retracement.